Hello everyone and welcome to this week's episode. Rob Skeen here, and I'm really pleased to have our guest today, Ian Maclachlan from Imperium Accounting and Tax. Ian is a chartered accountant, registered tax agent, and has over 14 years experience working with clients across a range of business advisory and taxation issues. Ian specialises in servicing clients running SMEs and understands the different dynamics in which they operate. Throughout his career, Ian has developed an expertise in the real estate, property development, entertainment and professional industries. Welcome, mate.
Thanks very much for having me, Rob. Glad to be here. Welcome, viewers.
Just thought we'd start off with a quick question. Where does the name Imperium derive from and the meaning behind it?
Yeah, really good question, Rob. So it's a Latin word, and it basically means power and command. So the idea of the business name is Imperium Accounting and Tax. So what we wanted to do was we wanted to give the power and the command back to the client in terms of their financial and tax affairs. And what that means is that they know where their financial and tax affairs are at, rather than lying awake in bed at night wondering where they're all at. So the aim is to give the client back the power and command in that, so they're comfortable, so then they can sleep easy at night.
Wonderful. Very good. Very proactive approach as opposed to being reactive. I love your service, and that's why we recommend you to our clients. So a very exciting topic today. A common question that we get is from a lot of our clients when they're buying an investment property is, should they be purchasing it in their own name? Should they be buying it in a company, or should be buying it in a trust? And I guess today you're going to be talking about that with us, and we're very excited to hear all about it. So if you can tell us why you think, what are some of the advantages of the trust scenario and what that looks like for property investors?
Yeah, thanks very much, Rob. Look, it is a very common question that I even get. And it's a funny one because over the years, generally the only two that have come up is individual and trust. But with the company tax rate lowering to 25%, the company is an option now as well. But we'll get to that at the end, okay? Because today what I wanted to cover off on, what does it look like owning property through a trust versus your individual name? Because there are some significant advantages. There are also some disadvantages, but we'll cover those as we get there. I think it's really important that we start off with what is a trust, because this is an entity which is often misunderstood. So a trust is a legally recognized relationship that exists between the trustee and the trust beneficiaries. After this slide, I'm going to show a diagram of what this structure looks like. So in other words, the trustee holds all the assets in a trust to the benefit of the trust beneficiaries. So this is compared to an individual or natural persons and companies, which are legal entities who can sue and be sued in law. A trust is not an entity in its own right. So the trust exists merely as a relationship between the legal owner, which is the trustee, and the beneficial owners, which are the beneficiaries. And any assets held in the trust are held in the name of the trustee.
In terms of asset protection, if someone was in a line of work, whether they're, could be sued for whatever reason, that could be beneficial in that regard, right?
That's exactly right, Rob. So when we look at these structures, so there's not one size fits all for any individual, any group of individuals, or any family group. Each situation needs to be assessed on its own merits. And then once we have assessed all those points, we would then recommend what structure we recommend for those individuals or that individual to hold the property in. If we do hold it in a trust, let's say that we get to the bottom of it and we decide that the best way to hold this property or properties is going to be in a trust structure, then this is what it looks like. Right. So you can see here in the blue, we've got the property trust. Now, the property trust can be called anything we want. It could be called the Rob Skeen Trust, the Ian Maclachlan Trust, but for the sake of ease here, I've just called it the property trust. Now,
just a quick point on that. Some people, that could be their self-managed super, right? That could be the self-managed super trust. Would that be right? Or
it could be. It could be. That's correct. It could be the self-managed super fund. Absolutely. But let's just, for the sake of argument today, say that we are looking at a discretionary trust and also a fixed trust. And I'll get to the importance of a fixed trust later in the webinar. So the property trust is going to be the entity that is going to be recording all the income and expenses. It's one that's going to be preparing a tax return and then distributing the money, if there is any profitable distribution, out to the beneficiaries. And I've got those there marked as B1, B2, and B3. Now, there could be only one beneficiary or there could be 100 beneficiaries, okay? That part is just endless, but for the sake of ease today, I've just put 3 beneficiaries.
What's standard? I mean, when we look at beneficiaries, is it, husband and wife?
That would be
directors of a company?
That would be a typical situation, Rob, where we've got a husband and wife, or we might even have a situation where it's a family group. So it might be a husband and wife, and then it might be another set of husband and wives, for example, as well.
Right. Company directors. So we could have, a couple of directors or 3 or 4 different directors of a company. Yeah.
Yeah, absolutely. Absolutely. And the beauty of doing it through a trust is with having those company directors as beneficiaries, if we invest in the property through the trust, it means that they can't be sued. But we'll get to those asset protection importances in a second. So basically, then this gold box here, this is a company, Property Pty Ltd, and this is the trustee for the property trust. Now, basically, the trust has to have a trustee, and that is the legal entity that is responsible for holding the property on behalf of the beneficiaries. So if anyone is to be sued, it is going to be the trustee that they're going to sue. Now, this is a really important piece because we're going to come to this shortly, is should I have an individual trustee or a corporate trustee? Now, if you think about it, if we have an individual trustee, then that might erode all of our asset protection benefits, which is why it's important to have a corporate beneficiary, which in this instance here, I've got Property Pty Ltd as the trustee. Now, that's basically going to be a $1 company. So if anyone's going to try and sue the trust, they have to look to sue the trustee. And that's what they're presented with, Property Pty Ltd that doesn't own anything, okay?
Right.
So let's now have a look at the next slide. So let's talk about the advantages and disadvantages of individual trustee. So really the only advantages of an individual trustee is that it's relatively easy to set up and they've got low ongoing management costs. Now, what I mean by that is obviously the individual trustee has to prepare a tax return. When we look at a corporate trustee, the corporate trustee then has to do regular ASIC documents and would have to lodge a company tax return. Even though if it's nil, it still needs to do that. And it also needs to do an annual solvency declaration. So the disadvantages of an individual trustee is it means that basically the individual trustee could be responsible for any legal issues with the trust. And it may be difficult to distinguish between the trustee's personal assets and the trust assets. Okay, so that's a really important piece. And if individual trustee dies, the trust assets are going to have to be transferred to another entity, and that's going to incur most likely stamp duty and also capital gains tax. When we look at a corporate trustee, look, in my eyes, in 99.9% of cases, we wouldn't have an individual trustee. It is going to be the corporate trustee. So that's really the main point to take from this. But let's look at the advantages of what a corporate trustee offers us. So it's limited liabilities for all the individuals, as a company is a separate legal entity. So this means that if there are any legal issues with the trust, i.e. the trust that owns a property, so in our diagram that we're talking about here, the property trust, the company is legally responsible and not the directors that are controlling it. So there's easier separation of the trust assets and personal assets as they're held in different names. So as a result, it's really straightforward to distinguish of which of a person's assets are part of the trust, which assets of that individual are not part of the trust. So there's greater asset protection. So if a person gets sued, for example, assets held in a separate trust with a corporate trustee are the company's assets and not that individual's. And now there's also simpler succession and control of the trust in the event of death. Since a company cannot die, the company continues to act as trustee if something happens to one of its directors, and the corporate trustee must simply just replace its director. That's all that needs to happen. So the title to the assets wouldn't even change. So the trust assets do not need to be transferred in the case of the death of one of the directors. So what are the disadvantages? Well, I touched on them briefly, but really there's not too many. Okay, maintaining records for the entity. So what do we need to do? Well, we need to set up a corporate trustee. So we need to set up a company, which will probably cost you about $1,100. Then each year we need to do an annual solvency declaration, and we also need to do pay ASIC their annual fee. So let's call those fees around about $500 each year, ongoing costs.
They're pretty insignificant, really, aren't they?
They're really insignificant, Rob. And, one of the best things that someone can do is when they set this up is to set up correctly from the beginning. And if you look at the cost, $500 a year compared to those asset protection risks, it's relatively simple that we would, as I said, in 99.9% of cases, be putting a corporate trustee in there instead of an individual trustee.
Absolutely. Absolute no-brainer.
So really, and we've touched on these briefly, but so the three, and I want the viewers to have this slide as the key takeaways. So the three advantages of buying property in a trust is 1, asset protection, which we've touched on. 2, there'll be tax benefits, and also estate planning, which we briefly touched on, and we'll go into those in greater detail now. So they're the major three advantages: asset protection, tax benefits, and then also estate planning. And they kind of are in order in my eyes, Rob. Asset protection is the main reason that we would want to do this, because the tax benefits, there's some questions there, and we would look at each individual circumstance on its own merits and judge that. And then also estate planning. Okay, so we do have that ease of transferring, or not even having to transfer the title of the property. So let's look at asset protection again, okay, because it's really important to hammer this home. So as the investment property is held in the trustee's name, not your own, the property is protected from creditors if one of the beneficiaries goes bankrupt or is the subject of legal action. So if you held the property in your individual name and that individual was to go bankrupt, the trust and the properties that are owned in it are wide open. If you had an individual trustee, likewise, if you didn't have a trust at all and you just held the assets in your personal name and that individual was to go bankrupt, then the property is wide open as well. So basically it means that creditors cannot use the property to settle any debts owed.
Can I throw another situation at you? I get that. Yeah, very good. Okay, let's look at this in terms of a different form of legal action. One of the directors, your daughter, adult daughter, gets married, gets divorced. Can that ex-spouse make a claim through this asset protection?
In that regard, no, they wouldn't. But in saying that, Rob, we would even put a special clause in there when we set this up to make sure that something like that was protected against. Okay? Mm-hmm. It's a really important part to look at. So let's look at the tax benefits. So there are tax benefits, but there also are tax disadvantages, which we'll look at shortly. So the trustee of a family trust has a flexibility to distribute any income generated from the investment property as they see fit. What that means is let's say at the end of the year, when we do the tax return or when we sit down and do our tax planning and we work out that there's going to be $100 to distribute to, we can distribute that $100 as we please. So we can distribute $416 to a minor. Now, let's say we had a university age child at that stage. So they're going to be in that ages between about 18 to 25 where they're not really working, or they might be working a part-time job. There is significant advantages there. We can utilize them for the $18,200 tax-free threshold. So individuals don't pay any tax up to $18,200. That's adults. Minors, after $416, they pay tax. Adults, $18,200. Nothing from that down to $0, no tax is paid. So there is really an advantage there.
That's fantastic.
Yeah, absolutely. So if you had 4 kids, and I've had this situation in the past, 4 kids within that 7-year age gap, I'm talking between 18 and 25, that weren't working and were maybe helping out mum and dad in the family business, then we could essentially distribute on paper to them $18,200 times 4, which is just under $80,000, which is quite a lot of tax-free money.
Fantastic.
Yeah, absolutely. So the trustee's got the discretion to determine that. And the way that we work it with our clients is we sit down and each year we work out the best way. So we're not paying $1 more than what we should be, really. And then on top of that, once we get above $18,200, we only pay 19 cents to $37,000, okay? So mum and dad working might be the top marginal rate of 47%, 46.5%. Now, basically what that means is that we can distribute more than the $18,200. We can distribute up to $37,000, and we're only going to pay 19 cents on the difference between the $37,000 and the $18,200, right? So that's the advantage really of these are the major tax advantages of having a trust.
Brilliant.
So if you didn't have anyone to distribute to, then obviously that's another case that we'd look at that individually, and there might be some other things that we can look at there. But now let's look at the estate planning. So we did touch on this before, but basically the trust deed is going to prescribe exactly how the trust is going to operate and each party's role in the trust. And effectively the control of the trust can be transferred without incurring capital gains tax or stamp duty. So let's say, for the sake of the argument, Rob, I held a property in my personal name, touch wood, I pass away, then there might potentially be capital gains tax, stamp duty issues there when that property passes to another entity. Now, basically, if that's held in a trust, this is going to eliminate any legal disputes and simplify the transfer process. So they're the three major benefits, okay? So asset protection, then you've got your tax benefits, and then also estate planning as well. But it's also important we look at the disadvantages of holding property in a trust as well. Now, the major one, well, I'm going to say major two, okay, are negative gearing and the land tax threshold. Now, I'm sure that, a lot of our viewers are fairly astute property investors and they know what negative gearing means. Basically, that means that, all of the expenses that you incur on that property are greater than the income that you bring in for that property. And a lot of people invest in property not only to obviously get that capital growth, but to also get this negatively geared tax advantage. Now, the way that works is that basically by the time those expenses outweighing the income goes into your personal tax return, it creates a loss, which means that you're then going to get a greater tax refund. Now, a trust cannot distribute losses. Okay, so that's a really important piece. So what that means is the trust retains these losses. So you're not going to get your negative gearing benefits in your trust each year, but where you will see the benefit of those losses is when you get to sell those properties, because the gain is then going to be offset with those losses. Okay, so basically think about it like this. Not having any negative gearing benefits, let's say over the course of 10 years. Now, let's say that those losses are $100,000 over 10 years, $10,000 a year. When you go to sell that property in 10 years' time, those losses, because they get retained and we accumulate those year on year, you're then going to be able to use those to offset against any capital gains that you have on selling the property. One advantage also that the trust has is that it is obviously eligible for the 50% capital gains tax discount, which individuals are as well. Companies aren't, okay? So that's one major reason why you would not invest in property in a company, is because companies do not get the capital gains tax 50% discount. Now, what that means is let's say that we make $100 capital gain on our property. If we hold that through an individual or trust, then that automatically, if we've held that for more than 12 months, that $100 automatically gets sliced into two, which would be $50. And then we just pay tax on that $50, okay? And the tax that we pay, because the trust doesn't pay any tax itself, it distributes the money to the individuals. The tax would then be based on that individual's marginal tax rate. So if we look at that example again, where you might have that school age, university age child that is, sitting between, might be working a little bit of a part-time job, we might have a lot of room to distribute money there up to the $37,000 and only pay the 19% tax. So one major disadvantage is the land tax threshold. Now, a lot of those discretionary trusts, they're not eligible for the land tax threshold, okay? But there is a way around that. And what we do is we basically make it a fixed trust. And a lot of fixed trusts, this is where it's really important that you get an accountant to set up these trust deeds for you, because with a lot of my clients, what we do is we make sure that there is a clause in there that says it is eligible, okay, in New South Wales and Victoria for the land tax threshold. And in that case, we would do it as a fixed trust. So that's a really important piece to understand. So as I said at the beginning of the top of the webinar, Rob, it's not a one size fits all. Yes. It really is and it's not even just a simple phone call discovery session. It really is to sit down for a couple of hours with the individuals to make sure that we've, that we're setting up the correct trust for them. Now, when we talk about the fixed trust, what that means is that generally the entitlements, the share owners, the beneficiary entitlements would be fixed. Obviously, that is going to work really well if we're going to be selling a trust within, 5 or 10 years time, or we might have that child which is now 15 and in 10 years time they're going to be 25, because basically then we're going to be able to distribute to them the entire amount of the capital gain. So it's really important that, like anything in tax, we start with the end in mind and then we build it from there. It's like when we're building a house, we want to know what it's going to look like. Or if you're building a set of IKEA furniture, you want to know, you want that picture of what it's going to look like at the end, and we've got to work our way to get to that picture, okay? So that's really important. It's not a one-size-fits-all. It really is an important thing to really sit down with the accountant for a good couple of hours and get them to ask all the questions, which is what we do, and then we would determine the most appropriate structure for you and your family group going forward, and really knowing that end in sight. We want to know what that house is going to look like when it's going to be built.
Fantastic. Well, Ian, what a pleasure to have your company here today. I think it was a very insightful look into how trusts work and perhaps how it could benefit our property investors out there. Thank you so much for sharing it today. Ladies and gentlemen, I will put Ian's details in the comment section below, so feel free to reach out to him. Also, his phone number's up on the screen as well, so perhaps you can call him direct too. Ian, thank you so much. And look forward to catching up with you again in the near future to talk about more property matters on the accountancy and tax side.
Anytime, more than welcome. Thanks very much.
Thank you.